Hey, good morning, everyone. Morning, or afternoon, right? I finally made it back to Europe. So it's the afternoon for me. But good morning, everyone. Hope you're all doing well. Happy Monday. The weekend's over, the month is over, the quarter is over, and it is October 2nd today that we're coming into this market week. There's a lot of movement last week, and I don't expect anything different from this week. We'll talk about the trade plan for the S&P 100 futures, what we could foresee for some of this movement. We'll talk a bit more about like tech as well. But overall, yesterday, if you guys are in our Discord or you're following us on social media, we were talking about how this gap, which was created by the US government not shutting down, one of the main topics of today, is going to be faded, right? So we're now down over 40 handles from the top of the overnight movement, right? Which is something that we were looking for throughout that session. So one of the good things about living in Europe is that we can trade the euro hours as well. So let's dive into this. Let's jump into what we got cooking here in terms of news. Hold on. Ba-ba-da-ba-bum. In terms of news, right, one of the main aspects was that the US government averted the shutdown, right? The Senate on Saturday passed, the US Senate passed a 45-day spending bill that the House passed earlier Saturday, averting the government shutdown that would have seen thousands of federal workers furloughed without pay. So the legislation, which was signed by President Biden before the midnight deadline, which was on Sunday's actually deadline, gives Congress more time to negotiate a full um, uh, FY 2024 budget. So the stopgap spending bills the government until November 17th, so again 45 days, at 2023 spending levels that include $16 billion in natural disaster relief, but no aid for Ukraine. So we can naturally see this aversion of the shutdown as good news for the economy and government workers. However, it may not necessarily be a positive for the overall stock market, right? What I was looking for is that there was a higher probability going into the weekend that the shutdown actually would materialize, and that would have resulted in the final rug pull, in my opinion, in the market before we start seeing that bottoming out scenario into the first few weeks of October. But you can see right now that we've sold off all of the overnight gap and then some. We're about to open lower than Friday's close realistically within the next 20 minutes, unless we pop 20 handles. But what this is shaping up to be is just continued controlled selling in this market that sparked from Friday. Friday, I was looking for that continuation to close out the month and the quarter strong. However, right, we got a lot of sell pressure that translated into today's market realistically. So let's look at a few more news events before we jump right into all of this stuff, right? I'm into where we can see this market going for the week, for the day, so on and so forth. Um, so realistically, right, there's other news as well in terms of payments in America. Millions of Americans are going to start making payments again on their federal student loans after a pandemic era pause for over 3 years that ended on Sunday. So this fanning of concerns spillover effect on the U.S. economy. Interest began accruing on loans again on September 1st, and payments came due starting Sunday. So in terms of the bigger picture, more than 40 million people together owe over $1.6 trillion in federal student loan debt. And note that the uh, uh, Joe Biden loan forgiveness plan was also blocked by the Supreme Court. And even so, administration policies are expected to blunt the impact of repayments, such as the income-driven repayment plan aimed at low-income households. So the resumption impact on households and the economy remain uncertain on account of unprecedented long breaks, and it could lower consumer spending by $9 billion per month, according to the Oxford Economics, and in turn reducing the 2023 GDP to 1.7%, resulting in a 0.3% decline in 2024. It's important because if we have those declines in GDP, remember recessionary pressures, you get two negative GDP quarters back to back, and you have a technical recession speaking, right? So there is the notion that later into 2024, at some point, with all these lagging effects and the uncertainty of macro conditions, right? All these economic conditions um, and data points, right, are lagging, which would lead into a recessionary environment or a larger market pullback at some point in the latter half of 2024. So this is another thing that adds to the impact, right? A lot of people are talking about a credit event, especially with yields extremely high, bond market in the gutter, right? A bond market crash potential, which puts a lot of downside pressure on equities, especially if the yields are super high. And all of this coming together, right, is putting pressure on a potential credit event that a lot of people have been speaking of for a very long time. So take it with a grain of salt, naturally, but things are looking to continuously add on to the potential negatives of the coming few quarters, right? I think the next 2 quarters are fairly bullish in the market, but things can start slipping up from there. Some of the other news, what we have from Apple and energy, right? Energy crude oil just concluded its best quarterly gain since the initial months of the war in Ukraine, right, with Russia. But Wall Street expects this rally to lose steam. Front month WTI closed Q3 with its best showing since Q1 2022, while energy stocks have also had a very strong quarter with the S&P, so the Spiders S&P oil and gas exploration production ETF XOP up 17%, but barring supply crisis, a few analysts also see oil prices above $100 barrel in the near term, and many think that prices can hover over $90 for the rest of the year. Right, while JP Morgan said higher oil prices are starting to weigh on demand, investment group leader HFIR believes that the oil rally is only just getting started. And I think that obviously it's putting up a downside pressure or upside pressure on inflation, downside pressure on the market, and also upside pressure on hawkishness from the Fed if all these oil prices continue to robustly increase like this. And this is something that I was talking about for quite some time. I know a lot of people mocked me here on YouTube. Oil, blah, 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 oil not going that high. Oil, blah blah blah. It's not going to run. Well, I still think and stand by that. It's been months now since we've been long the energy sector and oil. That's been doing extremely well. I think that a pullback is in order in the coming weeks, right? Maybe the coming months, but something very slow to the downside where oil sees maybe 85 to 80 bucks a a barrel, right? On the futures, I mean, and that downside is probably going to get picked up into the end of the year or at some point next year, realistically, to pump up above that $100 level. But I still think it's a very good play, the energy play coming up in the next 2 quarters specifically. So the last thing I do want to talk about before we take a look at the markets here, Apple, as we start the week, right? Apple and tech. So tech is still hovering very, very closely to its major support, right? It's just barely peaked under its August lows. If we take a look at the triple Qs or Nasdaq, right, in general, the market, it's barely peaked under its August lows, which again, lagging in comparison to other things. A lot of tech is being seen as overvalued, and that drop in tech can be the final, just like little knife in the market before we start seeing the bottoming in the next 1 to 2 weeks. So there's a possibility that tech and triple Qs don't see that knife push, but that last oversold max fear gauge would be a very, very great aspect to see markets bottoming with a little more concrete certainty, right? So names like Amazon, they've already started pulling down after they got sued, but you look at Google, you look at Microsoft, you look at Apple, they're holding fairly well. So Apple is in the news as well as we speak about this. It will address issues raised by users on the recent iPhone 15 models running too hot, right? Primarily blaming a software bug and not their sleek titanium casing. So the company is working on an updated iOS 17 system that powers the iPhone 15 lineup to prevent overheating. Separately, Evercore ISI highlighted strong iPhone 15 deliveries in the US, while demand in China and Japan has been slightly weaker. North America led times for iPhone 15 have hit record highs. Um, and an encouraging sign given the somewhat tepid response from the product's launch. Note that the Apple iPhone accounts for 48.5% of Apple's overall revenue in the most recent quarter. About 50% comes from iPhones. So I still like Apple for the longer term, right? I think that we just need that one little knife jab in tech to start this little rally here, but that's what I'll be looking at this week. I'm looking at oh geez, one second, sorry, super sorry. I mean to sneeze at you, but the I'm still looking at markets probably have peaked this week on Monday or Tuesday. We might have already seen the top of the S&P for the week. If we don't, right, it's another dead cat bounce in my opinion before we start bottoming out. But right now, the S&P, the futures, they're very close to the bottom of a distribution at 43.05 to oh 03. I expect some kind of holds from that area, but any close below that and a reoffer below that, you're going to see that 93. You're going to see that 80, that 75, right? And my downside target before things start stalling out is between 41.90 on the S&P and 42.35 on the S&P 100 futures. So I think that rallies do get sold. We've dropped quite significantly overnight. So seeing a buy, stop run, and profit taking off the open in the first few minutes to be expected. I'll be watching between 25 and 26 on the S&P 500 futures to see if they can offer there. It's a massive order flow pivot. And then 35, obviously, they're pretty far away. But I am leaning a little more to a pop and drop today and to start the session, to start the week. And we'll see how that holds out. Um, Sorry. I'm just reading some of these comments. Okay. Yield curve is the issue. Bonds and DOX still too strong. Yeah. Well, bond yields or bonds. That's the thing, because bonds aren't necessarily that strong realistically. But yeah, there's that for sure. I'm still just like looking at this from a volume order flow perspective, as well as like a cyclical and seasonal perspective in the market, seeing a potential bottom in equities in the one next to 2 weeks. But yeah, I another comment says November 5th, 2024 is next Pluto Saturn transit. That's when the wheels fall off. Honestly, no comment. I no, I don't really want to get into that. But anyways, uh, I hope you guys have a great start to the week. Um, let's get this thing rolling. Happy Monday. We'll do this again this week. And let's see what this market presents us. Remember, check out community.tradeproacademy.com for a free Discord, as well as at our website, right? You can get a free futures course, but I'm going to be opening up our live trading room for futures today, and we'll see where this market takes us. But I'm looking for a pop and drop realistically, get some profit off in the morning, and then see some of the sellers probably come in late morning or early afternoon or something. So I'll see you guys in there. Enjoy. We'll do this again tomorrow. Take care. Goodbye.